Welcome to this LinkedIn Live event sponsored by Marvin Labs. So, AI is supposed to kill SaaS. At least that's the narrative. Over the last year, that idea has gone mainstream. Agents replace software, interfaces disappear, entire categories of fintech get wiped out. But is that the case for financial services? The industry adopts technology differently. It's slower, constrained by regulation, and built on truth, trust, and accountability. We've seen similar claims before. Robo-advisors were meant to replace wealth managers. They didn't. So the real question is whether this time is different, or is it just another hype cycle? And that's what we'll unpack today, where AI is actually changing workflows, where it isn't, and what that means for how investors should think about fintech and financial infrastructure. I'd also encourage you to visit the blogs on Marvin Labs, which explore this topic, and several thought-provoking articles on Carroll Consulting and Advisory, where, if you remember the early James Bond movies, there's an interesting comparison with the laser in Goldfinger, definitely not written by AI. Well worth a read. Anyhow, I'd like to welcome our panel today, Stephen and Alex. First, Stephen, if you'd like to introduce yourself, your background, and your current role.
Thank you, James. So good morning, good afternoon, good evening to everyone. Stephen Carroll, 25 years, give or take, in the information services space. I left London Stock Exchange Group at the end of last year and have set up a consultancy focused on advisory services, which is corporate strategy, go-to-market, and marketing around this area. Delighted to be here.
Great, lovely to have you, Stephen, as well. Alex, would you like to introduce yourself and Marvin Labs as well?
Yeah, hi, I'm Alex. I'm the CEO and founder of Marvin Labs. With Marvin Labs, we bring AI to investment management. I am a banker and a professional investor by training, and have, together with a few friends, founded Marvin Labs about 2 years ago now. Yeah, I'm excited to talk about financial services, IT, financial services data with Stephen and with James today.
Brilliant, that's great. Thanks both. Right, well, let's jump straight in. And as always, you can ask a question. Feel free to put your question in the comments on LinkedIn, and we will do our best to answer it. But let's jump straight into the first question, which I'm sure we could spend an hour on, but we will summarize it quite quickly. Why has the narrative emerged that AI will kill SaaS? And I do actually hear this quite frequently. Stephen, do you want to take that one, and let's open that one up?
Yeah, of course. So like any kind of, hype cycle or mainstream consensus narrative, it's based on kernels of truth. So I think if you look at the quality, sophistication, abilities of AI products already, there are significant areas where they can either augment human capabilities, or in some types of more process-driven functions, they can automate those functions. But overall, I think that's a really important distinction to make in the topic between process automation and decision automation. So I think, if you want to take examples like middle and back office trading and settlement type functions, AI is probably going to be very powerful in helping to automate, reduce the size of teams in that space. Investment decision making, much more TBC. And then if you want to take investment decision making and be a little more nuanced about it, I think there's important considerations between the asset class that you're looking at. Equities, where most of the examples you see in social media tend to be in that area. Equities content, a large amount of it is available on the internet, and funds also. And I think in that area, the narrative probably makes its strongest case. And as you move into other areas, and as you consider other factors like regulatory or integration with major banking platforms, I think the narrative gets a little bit weaker and a little bit more kind of subject to further validation.
I think that's a good summary. I'll come back to that in a second, just after Alex's thoughts on that opening question about the AI will kill SaaS narrative.
Yeah, I think Stephen had hit the nail very much on the head. I think the big thing is, I think everybody that has been exposed to AI has seen AI replace one or two systems that they work with, and that's true, right? That's true across the board. Usually, that's systems that. So we used to tell the story that the last 30 years of software integrations were basically, the first 5-10 years we did all the easy stuff, and over the last 5 years we really did the hard stuff. We did the top down, force change into an organization, make a system work in an organization where it's really not meant to work, right? We think of all the failed CRM integrations. Think of all the failed ERP integrations, where what you really bought is not just an IT system. You bought thousands and hundreds of thousands of consultant hours. And I think everybody has seen that. You might be able to do something there. You might be able to do something on your CRM. You might do something on your marketing systems. And it works in some cases, and it works for some organizations. And I think that's a pretty interesting thing to see. And I think people have seen that some IT projects are easier than they thought 3 years ago, where everything was just top down, horrible, slow, painful. And I think that's what people got excited about, that it's easy and fun again to implement a CRM, which for the last 10 years it never was.
James, you're on mute.
Yeah, that's a good point, actually. I think you both make a very good point. And from my own experience, having worked in HSBC at a global level across multiple markets, and last year with a big tier 1 US bank, I think for me, the question is the point about this being, AI is removing, I think, friction on the surface of things, rather than actually wholesale change of, you mentioned, Stephen, core banking and things like that actually underneath. That I'm not convinced myself AI will kill SaaS. I think it's just tidying up at the moment much of the front end interfaces that I see, and it creates the impression it's going to do that. But the reality is that if I take one major global bank, it's still using core banking systems that have the old green crosshairs moving around the screen because it was coded so long ago. And I don't see any movement of AI taking out that type of service because the risk of change is too great. So I think it's, for me, more about AI removing the friction on the top, where things, as you say, Alex mentioned CRM systems, incredibly complicated, full of friction in the past, where AI is beginning to streamline that, consolidate information quicker, condense information much quicker, and help with the decision making. But it's not fundamentally changing the system underneath, which sort of, I guess, brings us to the second question, which is, are we seeing a structural shift, or is this, as we've just talked about, more of a hype cycle similar to some of the other things I mentioned? And I know, Stephen, you and I have talked about robo-advice as being another great example from a few years back.
Alex, do you want to go first?
No, please
Okay,
go ahead.
So it is a hype cycle, but elements of it are true. And I think, that there are a few limiting factors that really drive kind of the ability of AI. And the two that are most pressing to me, and so Alex's example of CRM is a good one, is whether there's some type of proprietary content or analytics, or whether it's just very much based on your own information. And of course, CRM is your customer information. It's not owned by any of the large CRM providers. And so in that environment, that's question number one that I always consider. And then question number two is whether there's any kind of to what degree is the operational risk and therefore the potential for regulatory scrutiny a factor, because banks ultimately are credit lending transmission into the real economy. Regulators don't want that to seize up, particularly in an environment such as this, where perhaps macro factors are unhelpful. And so that is also very important to consider, because corporate executives in financial services are not going to take risks that result in negative, embarrassing headlines for them.
Well,
I think
not knowingly do that.
All evidence to the contrary, perhaps, but
yeah, I can think of a.
Well, they're not deliberately taking the risk, right? They just jump into the risks unseen.
Alex.
I think, Stephen, there's a third component, which is when it's about like multiplayer systems, right? If we're thinking about things as simple as security settlement systems, where it's bank A settling with a bunch of different counterparties, where just the sheer complexity of architecture is probably an impediment to at least rapid change, and rapid change driven by a single party. I think whenever you have AI doesn't resolve the coordination problem that you have in these circumstances, right? AI might resolve a little bit of the software engineering problem and a little bit of the user interface problem, but it doesn't solve the coordination that is needed between hundreds of banks that are part of a security settlement system, for example.
Yeah, I can see lots of thumbs up and insight bubbles on LinkedIn. So I think you hit a good point there, Alex. And to the audience, if you want to ask questions, feel free to type it into the comments on this platform. I think for me, as we talked about, I think it's slightly narrower than the sort of headline grabbing, this is a hype cycle. I think when you look at how work's getting done, it is changing. It's not hypothetical. If you look at analysts, how they assess earnings calls, large data sets, and they're looking at those and moving through them much faster. That's reality. I mean, I'm doing that myself. I think where the hype creeps in from my point of view, again, and I've seen this, firsthand, is that people perhaps making the high level mistake that thinking faster workflow equals a full replacement of a system. It's faster and more efficient and condensing information, but it isn't a full replacement of a system. If you take the CRM analogy again, HubSpot, Pipedrive, all of those are still there, yet it is getting faster and more efficient to clean, organize, and target CRM prospects, but the core system's still there. And I think if I go back to that time when I was certainly in wealth management in HSBC, and you look at how robo-advisors changed distribution and pricing, there's no doubt about that, but they didn't remove the need for advice. That was still there, and for me this feels a little bit similar as a cycle, which I guess brings me to another question, which is how much of this narrative is driven by social media versus reality. Everyone loves the SaaS is dead kind of catchphrase. It creates post news, but how much of it is actually being driven by social media rather than reality? Stephen, what's your thoughts on that? Because I know you write a lot about this in your blog.
I think a significant amount of this cycle is being driven by social media, and whether you're looking on this platform, whether you're looking on Substack, people are looking for ways to win new subscribers and drive impressions and interaction, and this is a great topic. But as I've said, the underlying narrative in an equities sense has a lot of truth to it. There will be augmentation, if not automation, but the extrapolation of that trend into other more complex and different structures within asset classes and financial markets, that's much less safe ground, I would say. So, if you want to say death of SaaS within financial services, completely exaggerated, at least in the near term, is my reaction. But if you want to be much more narrow and say within equities, mutual funds, ETFs, areas without much IP protection on the content, then for sure that this is driving really fundamental change, and management teams in the incumbents have a huge amount of work to do.
No, I'd agree with that. Alex, what's your take on it?
Yeah, I think a while ago on social media, I think this might have all started. Like somebody shared how much money each of the large data vendors, financial data vendors, are spending on collection every year. And I think the first thing that I think that runs everyone's mind is, right, I can fetch a company report from the company website. Why do I need to spend $1 billion, $2 billion a year in doing that? And I think I think Stephen has a very, very good point, right? Everybody is always assuming that all the information that a financial data vendor has is financial numbers of large corporates that report in a standardized format, which is very much not the case. I think there are, if we kind of do the analysis a little bit tighter, I think there are some names that are probably have a risk factor there, where a lot of the data is kind of not really proprietary. I think everybody and their mother is kind of now parsing SEC data automatically, is starting to parse European financials automatically, and that clearly does something. But that also means that the people that are doing this, that have been doing this for 20 years, they will also discover how to do some of the automation work, and maybe the $2 billion they spent on data collection is going to be reduced by a little bit because they can also use AI. So I think it's always kind of worthwhile looking at what it does, obviously, to the revenue side of the businesses, how the businesses are kind of split between a more or less standardized data where you have high competition, where I have 99% data quality and your competitor has like 99.1%, and you're really you're scrubbing there, whether you have proprietary data, and really what it does to your cost structure if you are this financial data vendor, because your cost structure also is kind of moving along with your revenue structure.
Yeah, I'd agree with the cost structure point. I think also that we've seen a trend certainly over the last couple of years, especially on platforms like LinkedIn, for example, which changes its algorithm regularly to reward it's sort of simple and extreme positions. It's really interesting to notice posts that come out that have a very simple and extreme position that are totally inaccurate or just pure hyperbole, but yet they get circulation. And I think there's a danger that there's almost like as Steve said, a reality that's driven by likes, shares, and impressions that's pure fantasy. And then there's a more conservative, thoughtful reality, but this doesn't get circulated because it's not extreme enough in its view. And I see that regularly. And I think, someone who writes SaaS is dead and puts an exclamation mark and then 500 words all in individual bullet points to make you scroll down is going to get more traction than someone says something like SaaS is evolving but remains structurally important. That's going to get virtually nothing, even though the context and the content is far more valuable. I think for me as well, inside firms, and again, I talk here about global banks and last year a big tier 1 US bank that I was working with, you see firms adopting things very differently. There's a lot of experimentation. I still see people experimenting. I don't think it's reached a point yet where the narrative is as hard-coded as some of the points about SaaS being dead have been made. People are still experimenting. They're still trying to find their way. They're running pilots, doing use cases. We see that, Alex, don't we, in equity analysis? You see people ingesting Marvin Labs to experiment with how it can improve what they're doing versus what they're currently doing. And I think for me overall, there's a big gap between what is being said publicly on social media and what is actually happening operationally on the ground. And that gap, I think, is where this debate about, SaaS is dead is kind of filled as an easy route through it. Just to swing it round, we talked a lot about some of the challenges or some of the negatives with that point. But if we swing it around and say, where is AI genuinely transformative today? Stephen, do you want to share some examples on that you've seen where you've thought, oh, that's good, I'm impressed by that?
So sure. I think if we take modern AI in the generative sense, then its power for the consumption and summarization of documents is incredible, and the ability to search across an enormous corpus of text and pull out those pieces of insight, something that would take humans many hours to do, presuming they had those hours available. That is really powerful, and that, of course, has the effect of just bringing all of the necessary information to the decision maker quickly, efficiently, in a structured format. So that is a simple idea, and of course that's a kind of pull example. But ultimately, AI will be able to alert the user and say, hey, the company's filed a new document here. Here's a quick summary. 3 points, perhaps challenge the thesis that we talked about in the chat window yesterday. You could see it ultimately being, and I know it's now a branded term, but I find Copilot is a really useful way to think about the way that the AI is going to add value over time. And just to circle back, I think Alex said something super important about thinking not just on the revenue side, but the cost side. And I think there's this kind of false narrative that all of the risk sits with the incumbents and all of the opportunities sits with the disruptors. And I really struggle with that because, the examples we're giving around content collection, the incumbents have the most to gain through this AI automation and driving down the costs. And we rarely talk about the risks of the disruptors. And I've got two kind of examples there. One is profitability in the industry is somewhere in the future. And as a result of that, they remain kind of funding dependent. And for now, the funding cycle is favorable, but the valuations, if we think back to generation earlier of Uber and the like, they were allowed to remain unprofitable for a while, but ultimately, you look at what you pay for an Uber nowadays, it's no longer a cheap, it's no longer a cheap product, at least in the markets where I use it. It's now a business focused on cash flow and profitability. When that happens in the AI space and we kind of right size or come up with realistic costs, and thinking about some of the bottlenecks around energy there, I think that that will ultimately slow adoption rates. So there's a few things to consider that simple-minded death of SaaS narratives struggle to get into the true complexity.
I think you raised some good points there about the incumbents versus disruptors, and even incumbents that I see in the UK, for example, who are have disrupted the market. Revolut, for example, a banking brand which has now acquired its license, has struggled for many years to reach any credible profitability versus other banks. Alex, what's your take on where you've seen AI generally transformational, particularly as well, given what Marvin Labs does with transcripts and press releases and information around earnings season, which you see on a regular basis?
Yeah, so I think the big thing that AI brings in our niche and in investment research is really it brings the qualitative side a lot more structured into the conversation. The industry, since the introduction of Lotus 1-3 and Excel, has been incredibly quantitative. The quantitative side is incredibly deeply developed. We have sophisticated risk models. We have Excel spreadsheets that offer sophistication that is unbelievable. That is offer sophistication that we're now introducing AI into Excel spreadsheets, which is a weird thing to say, I think. But we've had for the longest time in the industry this very big schism between the quant side, the modeling side, the let's run the numbers, was incredibly sophisticated, incredibly well done. And the qualitative side of, all right, how does a business case work? What does the company do? What's the risk factors? What's the like, how does my thesis look against the numbers? That was always kind of the lag behind, because it required reading and required a lot of manual work. You didn't have risk management tools there. You didn't have kind of really good tooling in general for that. So I think what AI does is brings all the tooling to the qualitative side to get at least, well, try to get on par with the quantitative side. You can do risk management now on qualitative data, right? You can run a way to kind of track if your investment thesis is still up to date, still working. You can bring kind of the focused analysis on it. You can repeat the same analysis that you've done on one company on 100 companies kind of easily, right? It's still the same analogy as a spreadsheet, right? You can't just take your Uber analysis, just because we talked about them, and now run it on Excel mobile. But you can, just as you can't take the Uber spreadsheet and just put in Excel mobile numbers, you still need to make adjustments. But you start from a way more highly elevated level. And I think that's really what AI is bringing to our little niche, that you can treat the qualitative side in a way similar to the quantitative side. You can scale, you can risk manage, you can quality manage everything kind of way better than you could before.
Yeah, and I think that's a big step forward when you look at the industry over the last 20 years. I think for me, and we'll come to a question in a minute from Al Setikas. I think for me, there's three things to add to what you said, Alex, around earnings analysis, etc. I think where I've seen AI generally transformational is on the unstructured data, particularly, is ingesting it and quickly bringing some structure to multiple data sources. And one area I've seen that work really well is process mapping, where firms are trying to understand how various parts of a process, whether that be analysis or whether it be simply a process front to back on an area to try and make it more efficient, using AI to quickly pull in lots of unstructured information, analyze the process, and then come up with a conclusion about where optimization could occur, where new tech could be introduced, where processes are creating duplication, poor workflows, handoff. That's definitely an area that, your point about qualitative is well made in the investment analysis space, but qualitative review of manuals and processes, language-wise, I've seen a lot of success with that, then improving efficiency, improving handoffs, reducing, particularly in the regulatory space, reducing breaches due to human error because of the process not being set up right in the first place. Yeah. I think one thing I have seen transformational is, and there's a slight dichotomy here, transformational, and you made the point, Stephen, about decision making. It's been transformational in gathering information and creating crisper, sharper analysis for decision makers to make a decision. But the dichotomy is it doesn't mean that they'll make a better decision or they're any better themselves at making a decision. It's just produced much more streamlined, cleaner, sharper analysis for that. I do want to come just on this to the question that Al has raised, which perhaps if we start with you, Alex, and then we'll get your view on his question, Stephen, afterwards. How are you seeing AI shift capital allocation and budgeting across financial services, banks, hedge funds, and insurers? Which sectors are making the biggest bets on AI? Alex, do you want to take that first?
Yeah, can I just kind of finish one thought on this decision making versus decision assistance? I think really what the AI side has, what the kind of the new wave of AI systems has been missing is really the risk management side. It's really a side where you can figure out, you get some sense that your conclusion that is coming out of your decision support system is sensible. That you are able to track and automatically evaluate your decision making there as well. So I think that really is the thing that is necessary to kind of complete the circle. And I think kind of it's a little bit analogous with how we, like how most financial innovation is working, or most analysis innovation is working, right? We do the analysis first, and then we'll worry about the risk management side of things. And we'll, once we have both, then we really made the breakthroughs. And that might actually lead a little bit into the allocation decisions, because it is, I think, if you look at who's, like, where budgets are going, we're still talking budgets are going up. The big budgets for new AI solutions are coming out of less regulated space. So this is particular hedge funds. This is kind of some smaller banking players, not global tier one banks. And that's very much not insurance companies. So you still see the less regulated space being more active on the investment side. You see a lot of kind of more traditional, more regulated firms still in experimentation mode, which personally I think was a good position to have 2 years ago, but probably isn't the right position to have today. But I am obviously biased in this assessment as well.
Stephen, what's your take on capital allocation and which sectors are making the biggest bets on AI?
Yeah, so hello to Al, former Thomson Reuters and Starmine colleague. So I think the banks and asset managers, have collectively been quite thoughtful around where can they see, either significant improvements in their staff productivity or better decision making, faster decision making, and I'd kind of call out three main areas. We've talked a little bit about kind of the process automation and middle and back office type functions, where obviously banks would love to increase the automation in that space. They pay for a huge amount of headcount in that area, and if they can redeploy that headcount into more revenue generative functions, that's a win for them. And then from a front of house perspective, the three areas I think that there's really obvious synergy and near-term wins are, I would tie together investment banking and equity research, as they're looking at quite often the same content set. So whether it's a IPO process, M&A process, or equity research process that can be buy or sell side, all of those areas, the power of a tool like Marvin Labs to bring information, to synthesize information quickly, that's an area that the banks are investing heavily. And I don't think it's a coincidence that there's such a number of tools in that space. Investment banking, despite having a pretty rough couple of years, has really seen a disproportionate number of tools in that area. And then the other one I would call out is wealth tech, where the traditional advisor space was never that profitable. And I'm parking private banking, I'm referring more to kind of the mass affluent wealth advisory world. And the challenge for those advisors has always been the ability to personalize, to bring information, to add value to the customer, make them feel unique rather than one of a large number. And AI, of course, is going to increase the ability of that advisor to have all the right information at their fingertips to make the customer feel value. And that, of course, should increase retention rates, customer satisfaction, AUM, all of the metrics that the wealth industry operates on. So I'd call out those areas, I think.
I think you make a good point. Al, thanks for your question. I'd add probably the sector that Alex mentioned that isn't using it, which I found interesting, given I've worked with some of the big UK insurers over the last couple of years. If I look at things like rating engines, which you would think could benefit from the unstructured data point and vast amounts of information, thousands upon thousands of data points, which can have quite an impact on a rating engine and the claims ratio, for example. I don't see a huge amount of penetration into that beyond surface level consolidation and cleanup on data files themselves. So that's something I think is an interesting point that insurers, from my point of view, not every single one, but the ones I've seen have not really embraced, I guess, some of the AI penetration, particularly around rating engines. Coverage models, the same thing. Looking at where to build out the book, where to, when you've reached a certain quota of a certain demographic, age group or risk, where to push the prices up and close that group. Again, I don't see a huge amount of integration beyond the surface level. I still see a lot of human intervention at that level. So I think for me, it's more the point actually where I haven't seen it, because I think Alex and Stephen have already made points about where they have seen shifts. I've seen the other bit where I've still seen quite a sluggish movement, which is in the insurance space, particularly around rating engines, which it kind of brings us on to a question. Yep.
Just to respond to that, I agree, and I would just offer up that I suspect that there's probably two factors here. One is firms that service individuals tend to, have a fairly high amount of regulatory scrutiny, and so they'll be approaching those types of things with caution. And one of the challenges with the newer forms of AI is the ability to explain the decision, and whether you're looking at, credit or insurance, lending decisions or insurance decisions, these firms need to be able to explain how they reached a decision on any individual consumer, and kind of, in extremis, be able to prove that there was no bias inherent in the decision, that that the AI was blind to factors which are perhaps not allowed to be considered in these processes. And nowadays, from kind of neural networks onwards, it's been really hard to reverse engineer a decision from AI and explain how it was reached. And so I think kind of the nature of the beast just makes that quite a thorny challenge for the insurance industry. That I'm not an insurance expert. That would be my kind of reaction on the what you perceive as the limited enthusiasm or sluggishness.
Yeah, and I do get that, and I think that's a point well made, Stephen. I do get that. My only thought around it, though, is that, because I agree with you around it's a thorny issue, the uncertainty of how to explain it. But if I look at some of the algorithms that have been written for rating engines, they're incomprehensible in my mind to anyone other than a highly sophisticated maths project. And how you could unpick it and say it reached a certain point with thousands of bits of data in it, I don't know. But you make a good point about maybe there's a nervousness there that doesn't seem to be there with the old style of doing things, with maybe just coding an algorithm. Which sort of a question I want to come on to is around the actual data providers themselves. When you look at incumbents who are data providers and infrastructure platforms, what happens to them, do you think, over the coming 12, 18, 24 months? Stephen, what's your thoughts on that?
So, we've seen most of these firms, advance an argument that they have, deep, full moats due to content or infrastructure or other reasons. And certainly in the near term, I think, over the timelines you just asked about, I think that, they have the chance to make some easy wins on cost savings, that they have the tailwind that I think sometimes we forget just how transformational AI is in terms of data consumption. And for firms that sell data on a volume or transaction type model, that is good news for them. Over the longer term, that they absolutely need to kind of audit the types of content that they have, and understand which ones of those are going to be generally accessible to an AI tool, and which ones have greater protections, that they require licensing, and the IP protects them. And I think they need to start thinking about, well, how do we create more content sets like that? If there's one criticism I'd level at the incumbents, it's that they haven't been very innovative in recent years in creating new content that assists with deal making or investment processes, etc. I think there's an opportunity for them to take raw and commoditized content and do more with it, and turn raw content into analytics, if you like.
That's a good point about raw content. Alex, what's your thoughts on that?
Yeah, I think Steve raised kind of very valid points. I would be kind of a little bit more scared, I think, for some of the large data vendors. I think in particular ones that are heavy on it's weird calling them non-proprietary data sets, but on heavily competitive data sets. I think for them it is not just I think the moat on these it's basically breached, right? I think if you are trying to market a US financial data set, you have zero moat, right? I think right now you have zero moat, and maybe 2 years ago you had a little bit of a moat. This was, to be fair, right? This was never the most protected moat in the entire world to begin with, and now you've kind of breached it. There still might be some advantages some of the large vendors have in this space, but they increasingly are disappearing. But yeah, I mean, there is a considerable space for legacy vendors to do two things, I think, really. One is what Steve alluded to, which is really the figuring out how to create more powerful, useful data sets, and create them maybe with AI in mind, right? Not everything needs to fit into a CSV file. Not everything needs to fit into a table. I think we're seeing this already a little bit on, I'm kind of naturally a skeptical person of expert calls, but we see this a little bit in expert call space. And we're seeing this presumably in other space where like you can just create a data set that is very qualitative in nature because AI allows you to do that. And I think the other space really is they need to, like some of the big data vendors need to figure out the AI strategy. And I personally think it's not a valid AI strategy to say, as some do, right? The data is only accessible to our own internal systems. We are kind of against using something like an MCP or like a CLI tool, where you can pipe it into whatever system you want to do, whether this is Marvin Labs, whether it's Cloud Code, whether it's whatever. I think that is not a viable thing. So I think everybody needs to figure out, do I now want to push my own agent, my agent system? Do I want to push, do I want to cooperate with people? Or do I just, have a pricing model that is attractive for, for anyone, either because I'm licensing with a particular AI harness, either because I'm licensing with my customer and they can access the data in the AI system of their choice. But I think everybody needs to figure out how to do that. And I think that's the second big challenge, really. It's like, it's good data sets and it's figuring out what your AI strategy is, really.
James, if I could piggyback on Alex's point there, which I think is super important, and it's to consider the business model aspect of the industry. And even prior to AI, you had various incumbents, and I'd call out S&P and LSEG as being much more open to enterprise type deals, while other parts of the industry remain fixated or stubbornly attached to per seat, per user price models. Now, as AI automates, increases productivity, etc., I would say, or my impression is certainly that the per seat pricing model looks far more vulnerable than one which is agnostic to the delivery channel. So I think that commercial policy is something that needs to be looked at very closely if you want to truly assess the vulnerability of these guys, death of SaaS, etc. And that per seat model just looks much more challenged to me, much more strategically vulnerable.
Yeah. In particular, if you have a per seat model which then insists on their own AI capabilities, right? It's one thing to kind of keep the system. Well, I don't know what's worse, insisting on their own AI capabilities or keeping the system closed without any AI. But I think both are kind of, in my personal view at least, kind of challenging strategic decisions to make.
I agree with you. I think I'm skeptical about the moat concept. I mean, when I look around the physical world, there's lots of castles that are derelict and have been taken over with moats. So, you know, whilst I don't wish to be cynical, moats haven't always worked. And it's a phrase that I hear thrown up a lot about, oh, there's some good moats here. Yeah, take a look at how many castles are wrecked that thought they were safe, kind of thing. I think the risk is not that displacement will take place immediately. I think it'll be a slower kind of adoption. And if firms fail to integrate AI, I think it will just open the door for others to move a bit faster. But overall, I think, you know, we'll look at some data providers. They're not starting from zero, and you know, they have some significant advantages that are easy to underestimate, kind of thing. I want to come back to a question sort of linked to this, and back to the point you made earlier, Stephen, about disruptors versus incumbents. Does AI, this is quite a broad question, but does AI favor startups or incumbents? Stephen, do you want to take that big question and unpick it a little bit for us?
Yeah, I mean, there are a lot of ways to approach that question. I guess for the companies with large established content operations, AI provides the ability to really drive down costs or improve capabilities. And you know, from my time at LSEG, we always wished we had one more extra content team, because the content that we wanted was far greater than the OpEx budget allowed. Now AI flips that dynamic quite considerably, but on the other side, I think the incumbent vendors have a massive challenge in integrating AI into legacy technology stacks that were just not built or engineered, you know, with AI in the frame. So my reaction is that AI favors the disruptors in terms of being able to quickly code, develop, bring to market, adjust to customer feedback. You know, many of those arguments you would have made without AI in the frame, just because they're smaller and have more nimble tech teams, etc. And for AI adoption, AI, of course, being another technology, the disruptors can do a lot, but they have their own vulnerabilities too. So, you know, my answer is the disruptors have a natural advantage, but it's not an obvious and all-encompassing one.
Yeah. Alex, does AI favor startups over incumbents?
I feel I have to say yes, obviously, but I think it's always kind of, it is one of these, the grass is always green on the other side questions. I think as a startup, you're always jealous of the incumbent's advantage of like having natural customer relationships into all of these target firms, of not having that many questions on your IT security, IT ops, those kind of things. So I think it's both sides have an advantage, right? I think if as a startup, you love to have the discussion just on the product, and I think just on the product, you know, we see the big innovations coming out, the big innovations are not coming out of incumbents. But you even see this in startup space, right? You even see in startup space, the big innovations are no longer coming out of the people we thought were the innovators 2-3 years ago. But the big innovations are not coming out of the incumbents. but still, I'd love to have the sales teams, the distribution into these organizations. I'd love to have the data sets as a first class access, which is the advantage they have. So I think it's a little bit the grass is always greener on the other side kind of assessment here.
Yeah, I mean, it's a good analogy. The grass is always greener, and I think when I look at working in a large global bank, actually, I think startups and incumbents in financial services are actually all within the same mutually agreeable space, as it were. It suits large incumbents to have startups that can move fast, to take much higher risks, fail, test what doesn't work, take much bigger risks because maybe there's less of a brand, less of a big customer base, history, balance sheet at stake. So it's almost like a mutual ecosystem that it's great to have that. So I took an example. Wasn't that long ago, lots of startups in the banking space were looking at progressive onboarding, taking big risks with onboarding clients for moving money, opening bank accounts in ways that larger incumbents would never have taken the risks on. Many of those failed and it didn't work, and they took on very bad risks and poor credit books, etc., and also fraud. However, it did leave a residue that then the incumbents were able to absorb and scale the bits that actually were worth picking up and were worth looking at after the startups, where they didn't have as many customers, they didn't have as many risks. Whilst they had disrupted from the outside, the incumbents were able to absorb inside what they could take from those startups. And I think Revolut in the UK, a bank that has emerged 10 years ago, disrupting foreign exchange by simply offering foreign exchange prices that the big banks didn't really want to go down to price-wise, simply because they were making way too much profit from the whole exercise. It made no sense. But they have absorbed over that decade some of the progressive onboarding, some of the faster movement of money across borders, some of the UX and UI that has gone in to make moving money more accessible and easier to understand. All of that's been ingested into large global banks without some of the risks that took Revolut 10 years to get through the regulator to get classified as a bank because of that risk aspect. So I think for me, the startups and incumbents within financial services operate within an ecosystem that's more formed than I think many people realize about the place of AI and the place of fintechs. Just within the last 5-10 minutes, it'd be quite good to swing round to the question about investors evaluating fintech SaaS businesses. How should investors evaluate them, given what we've talked about in the last 50 minutes and the environment they're operating in? Stephen, if I come to you first on that, about how should investors evaluate fintech SaaS at the moment?
Can I just clarify, James? Are you referring to large incumbent info services companies, or are you referring to how should they evaluate like startup or organizations? Which bit are you pointing at?
The first. Let's go with the former.
So, it's a great question. It's a hard question. Firstly, you need to understand the intellectual property that underpins the content. If you are collecting exchange traded information from company corporate websites, if the process that you're supporting just requires end of day pricing, all things that no longer have any kind of moats around them, that's very different to if you are an aggregator of content that is not available and you can continue to license that into the foreseeable future. So really important to think through that content question. Secondly, I'd return to the commercial policy piece that I talked about earlier. And if you can create a commercial model that encourages customer consumption, allows them to get all of the benefits of AI systems while using your content, that of course is a safer model than if you're relying on continuing headcount for growth. I think continuing headcount in financial services is not a given over the medium term. The point we were talking about a moment ago, the small firms are good at innovation. The large firms are good at distribution and carry the content. So then I would want to kind of assess the partnership and distribution history to make sure that the firm looks well placed to take advantage of the innovation of the Marvin Labs of the world. I think those are the main points, but finally, and this isn't specific to information services at all, if you look at the M&A history of the last 10 years, some firms have been absolutely sharp and very impressive in their ability to buy assets before they became mainstream and expensive to acquire. Morningstar buying PitchBook, MSCI positioning itself in some of the private markets and other spaces where indices needed to be built. And S&P, they bought Kensho an awfully long time ago. Was the first AI acquisition that I had seen. I want to say that was probably about 2018. So that's a long time for given where AI was back then. So the management teams that have that kind of impressive foresight and ability to pick up assets when they're still cheap and true value is not yet understood, that's a hugely important component.
It's a very good point. Alex, do you want to add to those thoughts about how investors should evaluate those type of fintechs?
Yeah, I think the point that is probably just missing from Steve's collection really is one that he would probably make as well, which is look at the distribution, look at the content mix in terms of what asset classes the firms support. I think really, as Steve made this point, right? If all you do is end of day, if all you do is like heavily commoditized stuff, that's kind of easy to replace, and you probably lost your moat already. But if you do incredibly complex surveys or have specific industry data or specific data for asset classes, that is something that will still carry a moat. And I think in particular, if you're open to introduce and to generate either new content or new analyses based on proprietary or otherwise acquired content with the help of AI or assisted by AI or enabled by AI, I think then that's a very positive sign. I think I'd be looking at the firm that can articulate their AI strategy coherently and doesn't just see AI as a threat and doesn't just see AI as a way to put down costs, but they also see the potential of AI to improve their revenue and to improve their product.
I agree with that, and I think I'd add to that, Alex, that for me the basics still apply: revenue, quality, retention, unit economics. Those are there. The discussion and the noise around AI as an investor, you're still looking at revenue, quality, retention, and unit economics.
Alex phrased it very politely, but I think you could kind of more broadly say strategic coherence is an important one that I'm not sure is fully clear in some of these firms today.
Which, funnily enough, is something that a lot of AI tools, including Marvin Labs, can help analyze. That's a very good way of closing the loop. Strategic coherence, we've written about this kind of extensively. Strategic coherence is one of the big things that obviously separate good and from bad management teams.
That's great, and I think we'll close on that line. That's a good one about strategic coherence. If you want to read more about it, the Marvin Labs blogs are well worth a check out, as are the blogs from Stephen on Carroll Consulting and Advisory. All that remains for me to do is to thank the audience for taking part and listening today. Thank you, Alex, for contributing, and Stephen as well for your insights. Thank you, everybody.
Thank you.
Thank you so much.